Hello everyone, welcome, I am Sensei Kevlar. Today is Monday, and Monday we do mindsets. Monday Mindset Day has been the case since we started the dojo. Previously we have learned how to create no-loss strategies. We've also learned how to combine those with trophy strategies in order to create zero-cost opportunities for ourselves. On the downside, we do opportunity creation. On the upside, we take profits by scheduling our cells across the range of the market. In the 50-50, we straddle the market using half of the assets allocated for half of the opportunity, and half of the assets allocated for the other half of the opportunity at the 50-50 line. Combining these strategies together leads to a more complete strategy. And that's what we're going to be discussing today, is how to combine those three strategies together. So the idea is that with your left hand, you are doing the one position, double down, triple down, quadruple down. With your right hand, you are doing allocation against a price schedule. 50-50 at 100% at the top, or 0% allocation at the top, 100% allocation at the bottom, 50-50 in the middle. You then combine these two to do the complete strategy, where you are both layering and allocating your opportunities and your downsides on the high and on the low, all the way to the bottom and all the way to the top. That's the point. The point is to make a complete strategy which has you being profitable in any market condition, because these market conditions can get crazy. It's like the ocean, which is what we're looking at here. And within the ocean, there's lots of different motions, lots of different ways that we have to account for, lots of different ways that the waves can move, lots of different ways that we have to be agile within the ocean. And this ocean leads to another metaphor, which we're all pretty familiar with, sort of the fish in the sea metaphor. And so I'm going to describe to you the traditional fish in the sea metaphor that I think we're sort of all familiar with. And then I'm going to describe to you a different mindset, a different way of thinking about this process and how it relates to this metaphor. I'm going to give to you a new mindset, and I'm going to describe how that mindset relates to our strategy. And we're going to introduce some new vocabulary in doing so. This new vocabulary, if you start using it, will change your mindset. If you change the words in your mouth, you'll change the way you think about what it is you're doing. So the traditional way that people think about this is that there's a number of creatures within the... if I can get my... There we go. If I can get my thing to present here. There's a number of traditional creatures within the sea. The first and most obvious one being the minnow. The minnow is the little guy who comes in with their money, buys some crypto, because they think that the market is going to go up on them. And half the time, the minnows get lucky. They're little guys, and they get some minor wins. They're able to see the market rise on them, able to catch a wave onto a higher plateau, sell and exit and take their money and be happy. Of course, those minnows who then try and do this again eventually find themselves going down instead of up. And this is the story, I think, of everyone who goes out and tries to do trading, thinking that the market is going to go up, and then it goes down on them. That's just what happens. They get a bot, they get into a market, they try and do some trading, and then it goes away from them. And they get really upset by this. And sometimes they exit, sometimes they, stay in the game and try and figure out a better way. The whole point is that these are the small guys in the markets. They're not terribly interesting to us. More interesting is the shark, because the shark is in it for the win. He's here to play the game. He's here to actually work the market over and eat up all the little minnows as they get chummed out on these big motions. They're willing to take their losses, and they're trying to make more wins than losses. That's the whole point of their game. By eating the little minnows, as the little minnows get scared when the market goes down and they quickly sell their positions at a loss, the whale can gobble up some quick profits in terms of a low cost coin, and then later, in a week, a month, 6 months, a year or two, that coin will go up again and they can make their profits. The sharks are predatory. They absolutely are trying to create opportunities for themselves by following trends and trying to get out of trends that they think are going against them. They see the market as adversarial, and they are themselves adversarial to the market. They treat everything as they treat the whole of the ocean as their playground, in which they are looking for little fish and hoping to not get eaten by the bigger fish and pushed around by the bigger fish. But of course, that is exactly what happens to everyone who has ever found themselves in a losing trade, which they thought would not go against them, is they ended up in a situation where the motion of the ocean went against them. And the reason that the motion of the ocean goes against them is because of the whales. The whales, most people believe, or so the traditional thinking goes, are the high value individuals, the high net worth portfolios in the market. What they're doing is they are doing buying and selling activity in order to push the market around, and they are doing they have big portfolios, and they're taking big positions and absolutely trying to make this market in every way they can. They're trying to, when the market goes up, they're just they're making more and more money, and when the market goes down, they're taking bigger and bigger risks all the time and just waiting for it to come up. And they basically have unlimited cash because they can just go and get more cash. So if a position goes against them, it's not a big deal. They can just go throw more cash at the problem, and they can do this forever. And the idea behind the whale, traditionally, is that these guys are the market movers. And what I'm going to explain to you is that this thinking is not quite right. The high net worth individuals in this market aren't necessarily the ones who are moving the market around. Yes, they are whales. That's the definition of a whale, is they have a very large portfolio, or that they are moving within the market as if they had a large portfolio. And that's the point I want to make to you. Is it isn't necessarily about the ability to shove the market around. If you can move with the market like a whale does, in exactly the same way, taking the opportunities, no matter what direction the market comes, well, you're a whale. Even if you're doing this with a very small portfolio, you're maximizing your opportunities exactly like a whale does. This is the mindset of the whale. And the mindset of the whale is really critical. And I want to talk to you about how the mindset plays into our strategy. But before I do, I want to introduce to you a different set of analogies. Instead of the ocean being full of sharks and minnows and whales, I want you to think in a different mindset. And we're going to now change the way that which we approach this entire game. Okay? Again, this is about mindset. This is about the mindset of the whale. This is about thinking like a whale when you're making your strategies, when you're applying them, and how the whales make these strategies work for them in these markets. And so that's what I'm going to show you now. The analogy that I need you to lock onto is as follows. The whales are within the ocean. They are not the ocean themselves. They are taking the motion of the ocean and allocating their portfolio in order to move within those motions. Rather than trying to chase around the opportunities like the sharks do, and then get out of those opportunities when those opportunities go against them, or simply not knowing what it is that they're doing in trying to get in and get out of things. You need to think in terms of time in the market, of being here in a big way, of moving around in big motions, of taking those big opportunities while leveraging the smaller motions within the market. It's both at the same time, okay? The whale does not move the market. The whale allows the market to move to him. And this is a really critical aspect. But he doesn't just sit there and be sedimentary within the market either. He doesn't wait for it to just pivot around him. He also tries to be agile and nimble. And so we have our analogy here. We have the rock and the foam. The rock is the thing on the shore that the wave comes to. It sits there and it erodes his position. It does not. The whale does not sit there and make the market come to him. It is the rock, and the wave comes and erodes his position or gives him his small profits as the market moves over and over and over and over again. The lapping motion against the rock of the wave is what causes this structure to form, is what causes this discipline, this beauty, this absolute, potential to be created. If the whale is disciplined like the rock, the whale is the rock that the minnows and the sharks find themselves smashing up against. Okay? On the other hand, once his position has been eroded, once he's turned into the finest of sand and been eroded down into nothing, he wants to become light and move with the market as the market moves up and up and up and makes him more and more profits, or down and down and down as it gives him more opportunities. With every crest he wants to be moving higher, and with every trough he wants to be moving lower with his position. And so the whale is like the foam. He is light on top of the ocean. He does both. He sits there and waits for the ocean to come to him, waits for the market to come to him, and then moves with it on top of it. Light. Heavy. Light. The foam and the rock. These are the two metaphors that I'm going to be describing in our strategy moving forward. Let's see how it plays out. Coming back to the charts. Not now, please. There we go. How is old Bitcoin doing today? Let's take a look at the 3-hour chart for a minute. Previously, we have discussed how this opportunity was described to us through these predictive indicators. We have found how we can create these opportunities by scheduling this market. If we were to say this is our 0% allocation line, this is our 100% allocation line, we would say that this is approximately, where's our 50% line right here, this is approximately our 50-50 line. So we would come here, if we were here in the market, we would say, I'm going to allocate 50% of my position, and if the market goes up, I'm going to sell out all the way up to 100% of my position. If the market comes down, I'm going to buy up to 100% of my position. And in this way, I'm going to move with the market. Here I did some buying, here I did some selling. Here I did some more buying. Here I did some more selling. Here I did lots of selling. I did a little buying right here because I came down and touched this line, but then I sold it almost all my entire position up here if I was allocated for 100%. I then came down here and bought it back, everything that I had sold expensive here, I bought it back cheaper here. Then I came up here and I sold it. Well, what have I just described? I've described the motion of the ocean. So what the whale wants to do is he wants to play out a strategy that has him doing both. The way I describe this is we describe this in terms of allocation. And one of the things that we talked about is planning. Planning that allocation means that we get to here, and we have been disciplined to our plan. We've sold out 100% of our Bitcoins to dollars. If we were to get to here, we would have sold out, we have bought 100% of our Bitcoins using the dollars we had allocated. This doesn't have to be 100% of our portfolio. This only has to be 100% of the allocation for this opportunity. Let's say that we have $1,000 and we want to allocate $100 for this opportunity. Well, that's 10% of our portfolio. What we would do is we would sell out $50 here at the 50-50 line. But let's say that we were here at the, 90-10 line. Well, I would just sell out 90% of my opportunity right here. If this is really where I think I am in the market, okay, that's one option. If I were here, I would buy, I'd start out at 100% of my allocation. If I were here, I would start out with 20% of my allocation, or 80% of my allocation and 20%, okay? So if this is my 50-50 line, then surely this is my 60-40 line. 40-60 line, rather. 50-50 line, 40-60 line, 60-40 line. Depending upon where we are in the market according to my schedule, that's what I would allocate for. I wouldn't sit here and worry about the price. I'd worry about my schedule. I'd be looking back here and I'd be saying, where can this market go long term? And trying to allocate for instance, $5,000. And then when the market came up to here and it gave me this price right here, I'd be doing my selling. Now, if everybody was doing this, if everybody was selling when the market came up to here, and they were waiting like the rock and waiting for the ocean to come up and erode their position, well, you got a couple days at that price right there. Right up in here, get some good profit opportunity right here. Over and over and over again. If you had been selling, if you had sold at this point, you might have missed this profit potential right here. Now, being disciplined to the plan means that you do come up here and you sell. But having a strategy in place means being patient. It means being the rock. When the ocean comes up here and starts to erode your position, one thing that we've done is we've scheduled along the price axis. We've said when it reaches this price, that is when we will sell. That's a price schedule. Well, look at what else happened here. Is not only did we have a price schedule that was valid for this time frame, we also had a time schedule that was valid for this time frame. So rather than sit here and sell everything right here, if I know I'm going to sell X% at this level, I could allocate X% to sell at this level and say, okay, I'm going to sell now, and 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 now, and now, and now, and look at me, I'm making more profit right here. If I had allocated 100% of my selling right here, on this thing right here, on this candle right here, if I had allocated 100% of my selling on this, I would have gotten this much profit. But if I had allocated 10% of my selling that I wanted to do on this line, for this candle at this time, and 10% for this candle at this time, and 10% for this candle at this time, well, I might not have gotten the price here, but I would have gotten a better price here, here, and here. Look at all the upside potential I created for myself by not only selling on a price allocation schedule, but also on a time allocation schedule. Okay, so what do? Well, if I know that I'm going to sell out, if this is my 50-50 line right here, if I'm 50-50 in the market right here, come back to here and say I'm 50-50 in the market right here. I've sold my position out to 50%, because I've done my technical analysis and I've decided that this is my 50% line. If I know I'm waiting to come up to here, and I'm waiting to sell out 10% of my position, well, I allocate 10% of my position over 10 hours. That means that I sell 10% of that allocation for that sell once every hour. Go to a 1 hour chart and schedule that selling. I don't even know where we were. I'm going to schedule that selling once every hour. Say we come up here. I'm going to schedule that selling once every hour. I'm going to get a sell here and a sell here. A sell here, a sell here, a sell here, a sell here, a sell here. That's 5 sells, but I'm not going to get these sells because my price is not valid. 6 sells. Oh, look, more profit potential. 7, 8, 9, 10 sells. At this point, I would have done all of my selling that I had allocated at this price point. I would now be waiting for the next opportunity. Either it would go up here and I'd sell another 10%, or it would come down here and I'd buy everything that I had sold here back at a cheaper price. Am I going to buy it all back when it reaches this right here? No, I'm going to be the rock. I'm going to schedule my buying at this level. 1, 2, 3. We get an even better price. 4, 5, 6, 7. Maybe the price isn't valid. Oh, we do get the price. 8, 9. Maybe we don't get the price. Maybe we don't get the price. 10. Could have gotten better prices if I had scheduled longer. So it's not just about scheduling your allocation on the price schedule. Now it's about scheduling your allocation on the time schedule. We can do both. Okay? So now we're doing 4 things at the same time, right? It gets more interesting. The first thing that we did was we learned how to double up, triple up, quadruple up. The second thing that we learned how to do was how to allocate for the bottom. The third thing that we learned how to do was how to find our pivot line in the market and make that our 50-50 point so we could straddle this market. The next thing that we're now doing is we're scheduling our buying and selling on a time schedule. Not only are we scheduling our buying and selling on a price schedule, maybe we're doing percents going up, maybe we're doing dividers going up, maybe we're doing double up, triple up, maybe we're just buying 10%, 20%, maybe we're doing, 2x, 4x, 5x, whatever it is our strategy is telling us how much we're going to buy. Whatever our strategy is, it's telling us how much we're going to sell at this line. Whatever our strategy is, this is how much we're going to buy. This is how much we're going to sell. Now we need to introduce more strategy. Do we sell at this line? Is RSI over 70? Do we sell at this line? Is RSI over 70? Do we buy at this line? Is RSI below 30? Do we buy at this line? Is RSI below 30? More strategy. Do we buy at this line? Schedule, RSI, MACD. I'm sorry, not MACD, but Williams indicator. Getting ahead of myself here. More strategy. Schedule, RSI, Williams indicator, time. I know how much I can schedule out that selling over a time frame. I can give myself better prices on those buys. Rather than buying right here, if I buy once, twice, don't get the buy, don't get the buy, don't get the buy, 3 times, ooh, better price, 4, 5, 6, ooh, better price, 7, 8, 9, 10. I got better prices. I dragged what would have been my profit line, say I was doubling down, because my strategy told me I needed to double down right here. I dragged my profit line, if I was here and I was just going to double down, I was just going to go to here. If I just moved from here to here and I doubled down, that's where my new profit line would be. But look at what happened, is I cost averaged even further down. I brought my position even further down by doing more of my buying down here. I cost averaged my position further down, which gave me more profit potential by scheduling my buying out on a time frame. I can do the same thing going up. This tells me double up, triple up, quadruple up, divide, percent, whatever it is that you're selling, tells you how much you're going to sell. If you know you're profitable here, if you know you're going to be doing your selling here at this line, we'll schedule 1, 2, 3, 4. You don't get the price. 5, 6, 7, 8, 9, 10. Look at what happened. We're into our next scheduled sell point. But we haven't yet sold all of our previous sell point. Well, what do? Well, if we were scheduling our previous sell point to take this long, and this is how long we were scheduling it to take. We were scheduling it to take, this long, and then we didn't get all those sells off because the price became invalid. We don't want to sell below our target. We're going to be disciplined to our plan. So we scheduled 1, 2, 3. Oh, but we didn't get it, right? If this was our time frame, then we got this much of our time frame here, and then we got this much of our time frame, this much of our time frame here, and this much of our time frame right here, across right here. But then the price became invalid right here. It became invalid right here, and it became invalid right here. And then it became valid again. Well, look, we still had all of this scheduled distribution, and we've only gotten this scheduled distribution and this scheduled distribution. We still have this much left, so what do? We just take it up here. So now, we have this much selling we're supposed to do, and we have this much selling we're supposed to do. What do? Well, we just do it at the same time. Or, one option is we double up our selling. We sell 2 orders instead of 1. Okay? Another option is what? So we do that. We just schedule longer selling periods in order to do more selling to bring us up to our 30-70 line or down to our 40-60 line. Wherever we are in our allocation, this informs our schedule. This informs how much buying and selling we're going to do. So instead of buying and selling just at the line, instead of buying and selling only when the RSI is, or the MACD, Williams indicator is telling you that it's time to buy or sell, instead of buying or selling only on the resistance lines, we're going to do all of these, and We're going to schedule it out over time. What we're going to do is we're going to schedule our distribution. We're going to schedule distribution. We're going to be in distribution. We're going to distribute our Bitcoins out to dollars. We're not going to sell. We're going to distribute. We're in distribution. Then, once we come down, it's time to buy back what we previously sold, what we previously distributed. So we're going to allocate. We're going to say, I'm going to allocate more Bitcoins for this opportunity. I'm going to distribute the Bitcoins at a profit. I'm going to allocate the Bitcoins for opportunity. If you have all of your money right there in the market, if you have 50% Bitcoins and 50% dollars, we can just put the sell order in to sell your Bitcoins up here and put the buy order in to buy your Bitcoins down here with your dollars. Now, if you want to schedule those, we'll get out your plan. If you want to make sure that you're taking advantage of these opportunities and you're back testing your strategies correctly, well, let's take a look at what kind of time frames we can back test for. How long was this price valid? If this is our target distribution line right here, this change between this line and this line, if this is where we're going into distribution, because here we're neutral, here we're just waiting, here we're going to be in allocation, and here we're going to be in distribution, and here we're just waiting. This is dead zone for us right here. What kind of time frame can we schedule for? Well, I can tell you what it comes down to your plan, right? Get out your spreadsheet and tell me what type of plan you're going to make. Are you going to plan 2 weeks of distribution at this level? If so, come in and put an order in once a day. Wake up in the morning, spend 15 minutes, look at the chart, say am I in allocation or distribution? Did my order get hit? Do I need a new one at a better profit potential? And then go do the rest of the work for the day. Go do the rest of your life for the rest of your life. And then tomorrow come back and say, did my order get hit? Am I in allocation or distribution? And put in a new order accordingly, according to your plan. Does the plan say it's time to be in distribution? Does the plan say that the RSI is over? Is over? Does the plan say that we have potentially more upside to go? What does your plan tell you? Because if you've written the plan out, and the plan says that I am going to be distributing at each level over a 10-day period, and I've only gotten 5 days off so far, and then it goes up to the next level, well, you have two options. According to your plan, you can now put in 2 orders, or an order for 2 positions at this new level, right? At one at the old, one at the market price and one at this price. Or you can just take twice as long. Of course, we didn't quite reach our distribution line here, but we did here. So let's say that you didn't get all of your distribution off. Well, it seems you had a lot of opportunities to get your distribution off before you reach into your next line. But let's say it just shot right up and you gave you 3 levels of distribution that you went into. One opportunity, you could distribute longer. Another opportunity, you could distribute quicker. More distribution. On the downside, more allocation. Here, quicker allocation would have been better. You would have had, all of this opportunity, but look at this. Look at if you had scheduled this downside potential right here. So that's about maximizing your opportunities. By moving to a schedule, what you're doing is you're being the foam, because the foam is light. It can move up. It can move down. It can do anything it wants. You get 50-50, you get your straddle on. You get right into a market position that you like according to your schedule. Maybe it's your 60-40. Maybe it's your 70-20. Sorry. Maybe it's your 40-60. Maybe it's your 30-70. Maybe it's your 20-80 or your 90-10. Now what happens when you get here to your 20-80 and you've got this scheduled as your 90-10? Was it permissible to change the plan at that point? Well, certainly. All you got to do is change where you're allocating to, distributing to. Well, I got my words backwards today, don't I? All you got to do is change where you're distributing to, because if you change where you're distributing to, well, you're doing less selling at this point. You have less coins that you're going to be selling off. So you adjust your plan, and your plan tells you that you don't have, that you're only targeting, 70% or 80% allocation, and this is your new 90% line, and that you're already at 90% allocate. This is your new 10% line, and you're already at 20% distribution. So if you want to go into 20 more percent distribution, you better schedule your upside potential correctly. At this point at which you think the market can go higher, adjust your plan accordingly. Do less selling and wait for more levels. At the point at which you think you're going to start going down, do more selling. Look at what happened. Is back here we scheduled for 5,000, but then we never quite reached it. We scheduled our distribution at every one of these lines for 5,000. Okay? And at every one of these lines, the whales distributed and allocated and distributed and allocated some more and distributed some more. Here, we still thought that we had distribution opportunity left to go. We thought we were going to do this and stay up around here and give us time to be in distribution at 5,000 before we came back down. But then somebody pushed the market down. As a result, we had to prop it back up and do all of our distribution at 4,600 before the big push down. 3,900. If you had been in allocation all through here, you would have been fine. If you had been in distribution all through here, you would have been fine. How much is the price point? How often is how much is the price schedule? How often is the time schedule? Okay, in exactly the same way we were doing double up, triple up, quadruple up, coming down, divide up, percent up, going up with our left hand. In exactly the same way we're doing 50-50 allocation with our right hand. Now with our left foot, we're doing scheduling. This is the kick. I've taught you how to block. I've taught you how to punch. I've taught you armor. I've taught you dodge. Now, kick. Schedule your distribution or your allocation on a time frame. By doing so, you maximize your opportunities. In this way, you can maximize all of your downside potential. You can maximize all of your upside potential. And look, if you don't get your allocation off, you're fine. It doesn't matter. You just moved back into the correct allocation amount. You were trying for a new target allocation when the market came down. You were trying for a new target allocation of 50-50 because you were at 40-60 and you were trying to buy them all back, but you only achieved, you were trying to get your 50-50, you were at 40-60, but you only got to 45. Well, look at what happened. You actually reached back to 45. There's no problem here. You didn't need to go to 40. You could have gotten in some cheaper coins and made more profit by scheduling yourself out. And as soon as you didn't get all of your distribution, all of your allocation, I really have them backwards today. As soon as you didn't get all of your allocation out, well, it's time to go back into distribution mode. Because if this is your 40, if this is your 40, sorry, this is your 50-50, and you're at 40 here, and you go to here and you only reach 45% of your allocation, trying to go from 40 to 50, you only reach 45%. Well, look, you're just going back to from 45 to 40 right here. You can remain disciplined to this plan. You don't have to get excited. You don't have to go, oh, I didn't make my allocation target according to my time schedule. Not according to my price schedule. My price schedule told me how much and where. According to my strategy, if it was a good time or not. But look at, this was a good time, this was a good time, but this is a better time. Look at these right here. How could we have known that? Well, we could have compared this to this right here and said, well, I don't think this is quite the strong bottom that we think it is. If that's the case, if I'm not seeing a strong bottom, what can I do to change my plan? I can move my allocation schedule out. If I'm right here and I'm looking at this and I'm not seeing a strong bottom, maybe I get my 40% of my allocation, 50% of my allocation right here, but then it comes back up and I'm not seeing a strong bottom. I think I have more room to go down. Well, I can just hold on to my scheduled allocation at this level and just wait. And then later, I can do that scheduled allocation at a lower price point and make more examples for myself, make more opportunity for myself. So get out your piece of paper, get out your plan, get out your schedule. Make a schedule. Start by making a schedule. Nobody's going to do it for you. I'm not going to. You make a schedule and you schedule your 50-50. You schedule your 0% allocation at the top and your 100% allocation at the bottom. You figure out your buy and sell points. You figure out your strategy that's going to maximize your opportunity. Make a plan. Nobody's going to make the plan for you. You got to come in here and figure out if a time schedule of a day or 2 days or 10 days is going to be better for this market. Make a plan. Share the plan with the group. Get your spreadsheets. Post them in the chat. Google Docs has a sharing feature. Make a plan for each and every strategy, for each and every market. Make a different strategy for each and every market. This market allows you to do a 2x because it goes up and down. Other markets might require a 4x because they don't go up as fast. Test it. Test it moving backwards. Test it by going back here in the past and going, okay, I think this is my 50-50 line. I'm going to go 50-50 with my allocation. If I'm going to take $100, I'm going to say, okay, I have $100. I'm going to write it down on paper. If you're not doing this, you're not going to get it. If you're not getting out your piece of paper and your pencil, if you're not making a spreadsheet, if you are not sitting here doing this yourself, get out your trader view, get out your plan, make a plan. Say, this is my 50-50 line. This is where I'm going to go next. If I do this, well, what's 10%? 10% is $10. What's 10%? 10% is $10. Okay? That's one way of doing it. Well, that means $10 is one position. Okay? What if I want to do doubling up, tripling up, quadrupling up? Well, I can't use $10 right here because I have to buy $10, $10, $10, $10. Well, that's not doubling up, tripling up, quadrupling up. Figure out. If I have to spend $50 here, well, that's $25 here, $12.50 here, $6.25 here, $3 and $1.20, whatever. Okay, so your starting position was $1 and whatever cents for a $100 opportunity. $50 on this side, $50 on the other side. You undo that. Schedule your opportunities against your allocations. Schedule your allocations according to where you think the market is going to go. Create your opportunities based upon your schedules. Schedule that allocation and distribution. Allocation, distribution against a time schedule. The rock allows the ocean to come to it. It sits here and allows the ocean to erode its position at a increasingly better price. Better price, better price, better price. Increasingly better price, better price, better price. Here, maybe we didn't get all of our allocation in. Maybe we had to double up on our allocation down at this level right here from this level right here. This is our scheduled allocation. This is the next schedule of allocation. This would be the next schedule of allocation. That's our price schedule. Now make the time schedule. Now make the indicator. Now make the strategy. Now make the plan. Now trade the plan. And that is the way of the trader. Thank you very much.